Welcome to TheoTrade. This is Don Kaufman. It's December 29th, 2018, and you are watching the TheoTrade Weekend Update. So, some holiday volatility is upon us. Happy holidays to everyone, and of course, Happy New Year as we are coming to it. Now, I'm not going to spend a lot of time going over a year-end review. Sure, we'll do a little bit of that here at TheoTrade in the chat room, but I think what's much more important is a little bit of what I would term a volatility survival guide, and that's what I'm going to try to bring to your attention, of course, in this kind of weekend update. A few things about this previous week of trade. I mean, first of all, what can you say, right? It's Christmas. What would Christmas be without some wild and wicked volatility? Obviously, on Christmas Eve, on Monday, we have half a trading session where the S&P's absolutely tanked. Followed by the Boxing Day rally. Yes, that's the day after Christmas. And meanwhile, you have 3.5 days of trade. And a lot of you, including myself, have a lot of family in town. They're standing over your shoulder, watching you scalp S&P futures, driving you absolutely nuts. I mean, what else do you need for a like what I'll call a volatility cocktail? And that's effectively what we got thrown at us this last, 3.5 days of trade. But as I said, I want to be, again, kind of forward-looking and really kind of provide you a little bit of what I would term a volatility survival guide. So a few things moving forward, a couple of opinions to begin with. First, one of the things I'm, talking about a lot, lately on email and in our chat room is when people ask me is this volatility going to continue? Why would we believe otherwise? And, I talked about this on last weekend's video, but effectively, what you've had is a 10-year bullish run. We are now 13 weeks into some fairly extreme volatility. Now, the factors that are probably sparking this volatility haven't really changed. The Fed has still got their, foot on the accelerator of contracting the balance sheet. Again, this is not about raising interest rates, it's about the balance sheet. The political turmoil hasn't necessarily changed. In fact, there's probably more political turmoil coming, and that also, of course, includes Brexit. There's still a little bit of a slowdown in China. Again, you can throw out fact after fact after fact, but the bottom line is 10 years of buy-side activity in this marketplace is being met with some volatility, and moving forward, you should continue to expect the extreme. Maybe not as extreme, of course, as Christmas Eve, but I got to tell you, people just showed up to trade this holiday week, and they're likely to show up this next week to trade as well, even with the New Year's holiday. So with that, let me provide you a little bit of what I would term a volatility survival guide. Like, what does that really mean? All right, point number one I want to make. A market that is volatile, okay, is where opportunity comes about. A lot of people, they're buy and hold. That's fine. I get it, passive investment. But the real opportunities come, really in the midst of people kind of throwing up their guts. I'm sorry to be so graphic, but, when people are out there puking up their positions, that's when you're going to take advantage of, again, amazing opportunities. And we're nowhere near that. I mean, some short-term capitulation, you're like, down 100, 150 on the S&Ps. I like it. You're on fire right now. But again, the first thing we've got to get into your head about volatility. Number one point, control your risk. What does that even mean? If you have positions on right now, right here, if you're worried about those positions, I mean, when people are looking at their mouse every couple of seconds, you're on your phone. Forget about futures. You're looking at your positions on your phone nonstop, right? If that's you and you can't control your current position risk, how do you expect to function? Okay? And how do you expect to go after opportunities when they start to arise? So the first thing you have to do, you want to survive this, okay? Great. We'll come to that in just a moment. But if you want to look at this as an opportunity, you got to control the risk you currently have on. You better know what your net deltas are, right? And some of you don't speak Greek. That's fine. All right, what's your delta? What's your gamma? What's your theta? Bottom line, are you comfortable with your risk? And you need to think about, are you comfortable with your risk? Not just right this second. Are you comfortable with your risk if the S&Ps are going to swing around 200-300 points, okay, in the midst of a short period of time? And you actually have to stress test yourself to figure that out. I can't, I can give you every tool to be able to help you control your risk, but I can't do it for you, right? You got to be comfortable with your own risk. You kind of have to play go fish with yourself. What does that basically mean? It means you sit there and you go, am I comfortable making or losing $10,000 in a day? You're like, no! Well, that's go fish. Right? You got to figure out exactly where your risk parameters lie. Number 2 point that I want to make over here. In volatility survival, some of you are into swing trading, a little bit of trend trading. I have no problem with taking long or short positions in the midst of volatility. But I do have a problem if you go out there and you buy a stock just because you want, like, all right, I'm going to hold this for the next 3 weeks, or I'm going to hold this for next week, okay? You got to stop that. No long or short positions. No long or short positions for short-term gains. There is no reason to do it. Why would you get long or short stock when you can use options in lieu of a long or short stock position? Okay, a few things I'll show you here. Again, I don't want to talk about like what we just saw. Everybody knows what we just saw. We just saw some wild volatility. Newsflash, great. Okay, you got to think about moving forward right now. No long or short positions onto which you're actually going to be buying or selling stock. There's just no reason for it. What are you going to do? You go, oh, I'm going to go out and buy me some Apple right now, okay? And you're going to end up in something like Apple for the next 5 years. Everybody has some piece of junk in their portfolio because you went out and you tried to do a short-term trade, and it was a short-term trade, all of a sudden turned long-term investment. You know what I'm talking about. I'll show you a couple of strategies. Point number 3 to be made over here, okay? Leads right into this, from the no long or short positions. Use spreads. If you're trading options, use spreads wherever possible. You don't want to get caught buying a call looking for a rally. Because if you're going to buy a call looking for a rally, the volatility crush is going to suck the premium out of that call like there is no tomorrow. You know why? Because there is no tomorrow. Listen, you have to protect yourself. And spreads, option spreads, are going to protect yourself in the midst of volatility. Okay? The next point I want to make, and point number 4 over here, and then we're going to go into some of the charts. We're actually going to talk a little bit more strategy. You'll always hear the adage, in the midst of some volatility, you want to buy the dips and sell the rips, okay? Let's clarify something. You can't time anything, neither can I, all right? If you watched the marketplace throughout the course of this week, I hope that that becomes a little bit more of a reality. When the S&Ps looked like they're about to tank, the S&Ps the other day, they were down 70 points. Until they turned around for a 100-point rally. And I got to tell you, there's no magical mythical beast out there with a Fibonacci. You're like, oh, it hit the 618, and we decided to rally 100 S&P handles. Buying dips and selling rips. You're not going to be able to time this thing, so you're going to have to strategize around it. And again, I'm going to show you what that means here momentarily. This stuff, okay, this is just the tip of the iceberg. You have to have some type of volatility survival guide. And you got to realize what we're in right now, this is what's going to breed opportunity, okay? You just have to survive to actually see the other side and that opportunity. With that, let's get to the charts. To the charts we go. Before we get in detail once again regarding our volatility survival guide, let's talk a little bit about the marketplace. Let's look at a chart. All right, so to begin with, we are looking right now at the SPX happens to be a 9-month, but I'm going to zoom in even tighter than that. All the little hash marks all over your screen over here, yes, those are intentional. Those are our expected moves. So we kicked off volatility in the beginning of October. We've had 13 weeks now of madness inside of the marketplace. But let's do us a favor. Let's actually turn off. Let's turn off those expected moves for just a second. Remind you of a couple of price levels. So starting in October, we dropped into what I termed a volatility box. You're boxed in volatility, all right, where effectively you're high, you're low, you're so high that you're low, you go high, you go low. What did we do in December? We actually broke the volatility box. Now, we expected this. In fact, we highlighted this on the screen in some of the previous videos. We expected the volatility box. Okay, we did not expect, and I don't think anybody expected, the sheer magnitude of the break. Now, we break back to the upside. First of all, this break back to the upside right here, that's this week. That's the first, okay, real break back to the upside we've had. That's the quintessential rip your face off rally. In fact, okay, if you look for like the hallmarks of extreme volatility, if you look at the hallmarks of what, people kind of call that bear market, and I just don't like the label of the bear market either. Who cares whether it's down 19% or 20%, okay? But in effect, that's the exact hallmark of a much more bearish marketplace. And that is these explosive upside moves. And for those of you that have traded through this, will know just that. The explosion to the upside is often as kind of daunting as it is some sell side activity. And what those explosion to the upsides, what do they do? What do they leave us with? I'll tell you, for me, okay, it doesn't matter right now moving forward, whether you're long or whether you're short. You both have fear. That is exactly, okay, what the pop back to the upside creates, right? You get these pops to the upside, which again, categorically speaking, nobody's ever seen a pop to the upside like we had the other day. Obviously, 1,000-point plus Dow move in a day. I mean, that's so wild to the upside. It's crazy. But that strikes fear in the hearts of everybody that's short, because the shorts now are thinking to themselves, oh, they're going to buy the dip. Meanwhile, you got the people that are actually buying the dip on the other side of it going, this is totally crazy. I just bought this dip. Yeah, you're both totally nuts. Okay, because again, it's going to strike fear in the hearts of everybody. But again, that's one of the hallmarks of this volatility. Now, what would I expect? All right, what I would actually expect is a brief kind of soiree right back up here into, all right, the lower end of this volatility box. I wouldn't be surprised to see this rally, okay, kind of grip a little bit more hold. In fact, to relate this to the S&P futures, I'm going to relate it to the S&P futures. We may actually have a brief, kind of bout with 25.75 again. That happened to be the final gravity point in the breakdown of the marketplace. Because again, it's been, people look like the whole bounce. We'd bounce almost all the way back. We're not bouncing all the way back. Come on, we started at 2,900. It's a long road down. Anyway, I would expect some of the bounce to possibly kind of continue. Now, with that, what you can expect in the very near term, turn on the expected moves here. Okay, if you take a look at the expected moves for, again, this is this coming week. So let me actually highlight this on your screen. What are we looking for this next week? This is about an $84 move. Now it's an $84 move higher or an $84 move lower. That is the expectation of movement. Now, granted, we only have, though, 4 days this week. It's notable. New Year's Eve is a full trading session. So we have 4 full days this week with an $84 expected move. Again, for those of you that are a little newer to this, if you don't know where the $84 came from right here. It's about $84 is the expected move on the Jan 4s, right? So an $84 move. And to the high side, that takes us to 25, basically 70. It's right in the neighborhood. It's right in the neighborhood of hitting that gravity point, which is 25.75. To the downside, about 2,400. And that's if we stayed inside of quote unquote what was expected. Again, you should expect some fairly extreme volatility. So as I said, I wouldn't be surprised to see some more, if you will, upside in this marketplace. Now, you're going to note something here that I'm not going to really talk about individual stocks all that much. You want to know why? Yes, opportunities come in some individual stocks. But the bottom line is the markets, they've seen almost full-blown correlation. Okay, and to talk about correlation, we come over here to the heat map, go to index watch, cruise down to the S&P, for instance, 100. And during some of the wild volatility sessions, the advanced decline line over here, that advanced decline line was pegged on one side or the other. Effectively, what it meant is, there were periods this week we had 100 advancers or decliners. At that point, when you're getting full-blown correlation, and obviously Friday was a little bit of slop fest into the close, but when you're getting full-blown correlation, what does it matter? Well, you don't have to look at the financials. You don't have to look at tech. You don't have to look at Apple. You know, in the S&P 100, 100 stocks are doing whatever the S&Ps are doing. So it matters less about individual stocks and much more about the marketplace. All right, let's shift gears. Let's shift gears completely back, okay, to, listen, you just saw this happen, okay? In fact, okay, if you're me, your in-laws were standing over your shoulder watching it happen with you, which there's something nice about trading in the peace and quiet, okay, of nothing more than you and your computer. When people are standing over your shoulder, it's not nearly as much fun. With that, with all this volatility over here, how are you going to survive? Remember, point number one that I made over here was control your risk. Okay. What is your risk? Do you know what it is? Like, do you know what your risk is right now? And one of the ways you can go over to your risk, and here, this is, I just cruised over to the Analyze tab on thinkorswim, the most feared tab in the thinkorswim platform. I'm on a risk profile. If you don't have this, that's fine. Okay. I'm portfolio beta weighted to the spiders. And listen, we have classes on all of this. For those of you, you're a TheoTrade member, you can go in there and pull up portfolio beta weighting. Okay. I'll send you links to it. Listen, the bottom line is my delta right now, my beta weighted delta is negative 900. What that effectively means, let's just cut to the chase over here. What does it mean? Because we don't have enough time to explain every detail of it. Basically means, okay, if the spiders, here's the spiders. If the spiders go up $1 or if the spiders go down $1, okay, I'm going to make approximately, okay, $915 or I'm going to lose $915. Now, because I have the negative delta, where do I want the market to go? I want the market to effectively go down. So for me to make $915, I need to go down $1 on the spiders. If I see the spiders go up $1, I'm going to lose 915. Now, extrapolate that out. What does that mean? What do you mean extrapolate it out? You can come over here and you actually cruise over to what they call set slices. Look, this is just $2 and $5 out of the money. What that effectively means is, what are we going to make or lose if it go up $5 or down $5? And you can look at your P&L, right? And you're like, I don't like that. Good. Then take it even further, right? And I'm just playing around with a couple of positions in here. What happens if we move $10 in either direction? Because the expected move in the spiders this week, let's go over to it. Come on, this is just this week. The expected move is $8 and, almost 50 cents. So go into the Analyze tab and saying, what if we go up $10 or down $10? Okay, my positions are effectively going to make or lose almost $10,000. That's just in this one account. And you can kind of go through each individual account. It's a party, people. But if you can't figure out what your risk is, you're dead. You're not going to be able to go after the opportunities. Right. Point number one, made. Point number two, I told you, you don't get long or short stock. What's the point? I think the spiders are going up. What, you should buy them? Okay, why would you turn around and buy 100 shares of the spiders because you think they're going to go up over the next day or two? You hold this position overnight? Look, there's an $8 expected move. Like 100 shares, you're going to make or lose a couple of $100 overnight. That's not the position that I want to be in. You don't need to be long or short stock in the short term. Instead, and by the way, this is not just for the spiders. Okay, there's always one in the room like, I'm gonna go out and buy me some Tesla. Okay, it's crazy. Like again, Tesla is expected to move $25 in the next 6 days. Right? Do you want to lose money? You're like, no, I want to make money. Good. That's great. You're on the right path, but there's no reason, okay, in the midst of what you're seeing, which is what we would term the extreme. In the extreme, you don't get long or short stock. You need to wipe the memory. I know a lot of people are going to be like, let's look at the year of 2018. You need to wipe the slate clean. Who cares? Right? Oh, 20 years ago, this happened. Doesn't matter. What matters right now is you surviving, moving forward. And I'm going to tell you, okay, doesn't matter what, 2-3 years ago, you could buy some stock and actually hold it. And what? Because we were trading in what? A 10 VIX? We're trading in a 10 VIX? Well, wake up. You're in a 30 VIX. Your hair is on fire. Okay. You can't get caught long or short in the short term. Everything you do, spread your risk, spread your risk, spread your risk. What does that effectively mean? You don't go out there. You can't just buy a call, because if you just buy a call, what's going to happen? Here, just look 6 days out, look 60 days out. I don't care. See that volatility? That volatility is going to do what? It's going to get crushed the second this market starts to get what? To rally. So that's $4 a premium you're buying. That's all volatility. You're just buying volatility. In a marketplace, when you buy a call and the market rallies, they're going to crush the volatility out of that. It's not going to be good for you. That's an option for 6 days. The at-the-money options trading for like $4. Okay, you go out a little further in time. Like, look how much premium is in these things. You're crazy. You can't buy just an outright option that's at the money or out of the money because there's just too much volatility in it. So what do you have to do? You got to spread your risk, because what spreading will do, if you want to take a directional position, you buy one of these, right? For instance, buy one of these and sell one of these. It's offsetting the the volatility component. The options have a volatility component. We call that component vega. Vega is the option's sensitivity to changes in implied volatility. But what a spread does, in effect, and again, you could use any spread you want, out of the money, in the money, whatever. I'm just showing you an example. Okay, this is vega. Vega, again, option sensitivity to changes in implied volatility. If you use a spread, you're getting long vega with one hand, short vega with the other hand, right? Because you can kind of be long or short. That's what a spread is. Long one option, short another option. So you're buying volatility and selling volatility. You know what that does? It offsets the volatility risk. Done. Use spreads where possible. The fourth thing I wanted to mention in here, okay? Everybody makes this sound so easy. I should buy the dips and sell the rips. Yeah, good luck with that. Again, there's no magical, mythical 618 that's going to pop out of there and be like, it's a Fibonacci. You have to realize that in the midst of some really extreme volatility, no one cares what your level happens to be. We don't adhere to levels. Okay, look at December. It's a full, just puke fest in the marketplace. But we ain't home yet. But wait, there's more. This thing is going to get even more hostile before it gets better. Stop trying to pick levels. And when somebody says, buy dips and sell rips, I get it. But in effect, to do that, you got to come in here and you got to use some spread trades. Pick your entry point. Be totally comfortable with the risk. In effect, what I'm actually doing, I've already actually geared myself to selling more premium than I have. I don't want to mess around with trying to buy dips and sell rips. Listen, when the market sells off hard, really, really hard, I'll be out there selling a couple irons, maybe selling some out-of-the-money put spreads. That's it. Out-of-the-money stuff is what I'm actually selling. Okay, so we're coming down. We're coming down fast and hard. I'm going to sell into the volatility. On the giant pop, I'm going to cover some of that volatility. That's how you function. As long as you have your risk under control, but that's how you can function. And this whole idea of buying dips and selling rips over here, yeah, it sounds wonderful. But in retrospect, you're not going to pick a top and you're not going to pick a bottom because this marketplace, it's good at tormenting everybody. And that's one of the final thoughts I'll leave you is you have to look at the marketplace just as that, and I know that sounds like, it's an evil way to leave you here on the start of a new year, but the market goes as far out of its way as possible to torture each and every one of us individually. And once you get that through your head, you can control your risk. Okay, there is unbelievable opportunity in this volatility. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.